What's up, everybody? Michael Silva here. You're watching the Stock Market Brief Show. Today's episode going to be a little bit differently than the usual weekly recap. I want to kind of give you expectations going into 2022. I'm sure we've all heard the saying, don't fight the Fed, right? The Fed's got your back when the market falls. Blah, 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 blah. So if that's really the case, we need to pay attention to what the Fed has done and what the Fed is saying that they're going to do, and if they're going to hold to what they're continuing saying to do, because we do have an FOMC meeting here in December taking place, and it's going to be an important one. So let's take a little walk down memory lane and jog our memory just to get a good context of what to expect coming into the year end and the beginning of 2022 in today's episode. Let's get into it. All right, everybody, welcome back to the show. We are looking at the yields here back in 2019. Why am I showing you this? The reason why I'm showing you this is because when yield curves invert, okay, when, for example, you can get more yield from a 2-year than a 10-year, that is called a yield curve inversion, and it's known to be one of the best leading indicators of an economic recession. Okay, and in September of 2019, towards the end of the year in 2019, the 10-2 spread right here, you can see, got below zero. When it gets below zero, that is a yield curve inversion. What did the market do during that time? Well, it got pretty volatile, right? There was big shake-ups, shakedowns, and it really didn't go anywhere since, I guess, really since, if you just look at this little low right here, boom, come all the way back, April. So for 1, 2, 3, 4, 5, 6 months, it didn't do much of anything except chop back and forth, okay? And then we get this yield curve inversion, and then what takes place? Well, the Fed starts lowering its Fed's fund rate. Now, there's reasons as to why, and they were doing this about the trade war, the back and forth trade deal between China and America. This was during the Trump presidency. And they actually were lowering it ahead of time, but you can see here in September, once the yield curve's inverted, they actually aggressively lowered it lower and lower. And obviously, when the Fed's fund rate goes lower and lower or near zero, it does force people into risk assets as money becomes, cheap. And you can see here the market continued pressing higher. But leading up to that, you can see here from 2016, 2017, 2018 into 2019, the Fed fund rate, they were actually raising rates, right? They were taking away the punch bowl a little bit. But as you can see, when it got to a certain extent, we started seeing some insane market volatility in early 2018 and even late 2018, if you remember all of that was going on. Then they said, okay, they basically backed off raising rates and then begin to lower them. It wasn't until January 9th where the World Health Organization, they announced that mysterious ammonia in Wuhan, China, that we all know is COVID. And that wasn't even enough to really shake up the market. The market continued pressing higher and higher there. It wasn't until about January 23rd when Wuhan, they went under quarantine, and then January 31st, the World Health Organization issued that global health emergency. That's what really kind of shook and jarred the markets. As you can see, that gap up and then completely reversed on itself, and then we had a big gap down, and it kind of came up after that point. But that was when the market started saying, oh, there is something a little bit wrong here. Now, what's important to pay attention in all of this is how the Fed responded. And how they responded during that process can give us maybe insights to what to expect coming out of all of this cheap money and liquidity that they've been pouring into the overall markets. So on March 2nd, they held an emergency video conference and they decided to cut interest rates by 50 basis points. Okay, March 15th, actually, you know what, before even getting to March 15th, during that time, March 11th, 13th, World Health Organization declared COVID as a pandemic. Now pay attention to these dates. Okay, this is where it gets very important. They declared it's a pandemic, and then it was a national emergency. Trump declared it a national emergency. And then we started banning on non-U.S. citizen travel from Europe, and that went into effect then. Okay, so March 15th comes around and there was another emergency video conference. The Fed slashed rates by 100 basis points to near zero. Okay, March 16th through 34th, they launched a large range of measures to increase liquidity in the financial markets and promise unlimited, open-ended, large-scale asset purchases, including purchases of corporate and municipal bonds. Then on April 9th, the Fed rolls out $2.3 trillion in emergency lending efforts to bolster local governments. Now, this is all important, okay? Because if we're paying very close attention here to these dates, when did that take place? That took place at peak fear in the markets, right? The market in March, this was the bottom. We didn't know that at the time, but as you can see clearly here, the Fed started introducing all this range of tools, okay, at the very bottom of the market, which means what? It means that the Fed, the Federal Reserve, has a large impact on what takes place in these overall financial markets, which many people already know, okay? This is also at the time where you started seeing CNBC, like Bill Ackman. He warned that hell is coming. When did he say that? He said that March 18th. This is March 18th. That's the bottom. We didn't know it like at the time, right? If we're looking at this chart, we're like, oh, the world's ending, right? This was a very scary time. But noticing that the Fed really stepped in and what they did to provide liquidity to the markets obviously fueled something very big. Now, March 26th, very right near that bottom too, the Senate passes the CARES Act. Trump signed the CARES Act into law. So we're talking, we got the Fed that has our back. We have the government that has our back. All of these things taking place. What starts happening to the overall S&P 500? We'll use that as kind of the benchmark. Well, it starts ripping to the upside. And keep in mind, this is about the time that lockdown started to begin, almost around the time, right? I think it was April, okay? So as you can see here, yes, the Fed fund rate got smashed down to zero. You can see the M2 money supply. Let's begin takeoff, completely just up to the sky right there and started heading higher. And then you can see, yes, April, as cases continue to surge during the pandemic, businesses start to shut down, schools closed, sporting events canceled. There's Coco going crazy again. And then college students, they had to go home. And then people started wearing masks and practicing that social distancing. So one has to think, okay? So during this peak fear, everything's being shut down. No one's going anywhere. People are social distancing. The Fed steps in. Okay, so people that are very aware understand what could take place in these markets. Okay, however, the average Joe and the average person is looking at this like, oh my gosh, like I'm not going to work, I'm not doing this. Well, let's look towards the financial markets. What's going on? Oh, my portfolio is dropping. What do I do? What do I do? It brings a lot of attention to risk assets. Now, this is where it got kind of interesting. When we talked about sports being shut down, you can see here New York Times posted an article and they were giving updates on what was basically being shut down. And by the way, this is a huge industry, right? So tennis, their stuff was canceled or postponed. Hockey, football, Olympics, baseball, running, winter sports, cricket, golf, soccer, auto racing. And then also shortly thereafter, Las Vegas Strip shut down. So casinos started to get shut down. This is about the time that I put out a video saying, oh man, if all of these things are being shut down, which by the way, the gambling industry is huge, not only just like at a casino, but sports betting is also very big. And this is what really kind of set this big boom up in this retail trading industry. As you can see, Davey Day Trader, right? Dave Portnoy from Barstool Sports, he's a huge sports bettor. But when you can't bet on sports because everything's getting shut down, but the markets are open, well, what do? You turn to the markets. The gambling is, like I said, a huge industry. But that's not just to say just one single person. TD Ameritrade, they started posting record retail trading activity and account growth during the second quarter of 2022. The firm added 661,000 new accounts over that period as retail investors flooded the markets. Interactive brokers, they reported an 111% increase in daily average revenue trades year over year. If you look at Robinhood users, Huge surge in 2019, 2020, and then also even into 2021. So what does this mean, right? So no one's going anywhere. Their jobs are getting kind of just put on, the back burner. And where do they turn to? Well, one of the biggest things that they turn to is what are they going to do financially? And then they start looking at the stock market. And you can see that here. You can visually see the transition in this various data to suggest that. So what does that really mean? It means that the game is on. Now, during that period of time, when you had the Fed that had your back, you can be blindfolded at this specific time and you can throw darts at a dartboard and you will hit a bullseye. And that's what creates a lot of confidence in various retail traders. And it also creates, large scale influencers. For example, Cathie Wood of the ARK Fund. I mean, look at the growth of this ARK Fund from when it hit the March bottom. It came down to just under $35 and it ran up to $160 in a single year. So yeah, she was on all the big talk shows, right? All like CNBC, all those big news things and being praised. But really, when you really look at it, you look at the M2 money supply, I mean, it almost creates an illusion, right? So it's just important to note that, like, if the Fed didn't step in here, would there be Cathie Woods right here at her ARK Fund up at this high? It's very hard to determine. But it's not just the ARK Fund. I'm not saying picking on her or anything like that. If you look at Peloton, right? All of a sudden, all of these stocks, these stay-at-home stocks, people started pouring into, right? So at March, this was below $20. It ran up to $175 that year in 2020. Tesla, huge run from 75 to 925. Zoom Video, another one right up under $100, under $75, up to $600. That's absolutely incredible. PayPal, same situation. Penn Gaming, another huge runner. Roku, look at this. This thing hit $60 and ran up to $440. Bitcoin was another one. Bitcoin tapped into around 4,000 and just that year ran up to around 27, 28 and still trading very, very high right now. Okay, so that's 2020. When the Fed has your back, you don't want to fight the Fed right here, right? But what if they don't got your back? What if, would you want to fight them at that point? That's what today's episode is really kind of about. And during this run up, right, what took place in the markets, I'm just trying to give you my thought process overall. We had this rise of the finfluencers, a bunch of YouTubers, right, making it big by introducing millions of people to stock investing. And this is legitimate. And my channel felt this growth and felt this impact, right? So I started my channel 2 years ago. And when everything started going on lockdown, right, when casinos closed, when everyone had to stay at home, when people weren't working, right? What were people doing? They were turning to the financial markets and they were looking on YouTube significantly more. And that created just this huge boom within various channels. Now, what's crazy to me is, it can't always be like this, right? It's not just going to stay at high these peaks. But 2021 came around, right? That was 2020. 2021 came around, and still the madness, the insanity, the fun of meme stocks, and then also all these SPACs that were coming out, right? So AMC from a $2 to $74 here in 2021. Bam, it was a huge move. GameStop, another big mover, right? Under $5 or something like that, up to $500. You had BlackBerry, come on now, a $6.50 up to $29, huge run. Tilray, Clove, right? We saw that big pop. NAKD, Naked Brands Group, another huge move there. KOSS, I mean, this was around $2 and came up to $130. This is absolutely insanity taking place. But what happens during these times, you got to understand, people feel very smart. People feel very intelligent if they caught the right side of this trade. So they think that they can just duplicate this over and over again, not understanding that market conditions, they do change. It's not always like that. This is not typical to see in the market. This is a first time for us seeing this take place in the market. Okay, and now 2021, it's coming to an end. We're going into 2022, okay? So what now are we starting to see? This is where it gets interesting, okay? So two top Federal Reserve officials, they retired after trading disclosures, right? Kaplan and Rosengren, I think there was another one too that stepped away from the Fed. Now, this is very interesting, right? They were also getting in on all of this Fed policy going in. They were taking multi-million-dollar trades, benefiting from what their policies were being taking place. But that doesn't even stop there. Wall Street Journal reported that federal judges or the brokers were trading stocks during the litigations, during these trading stocks of litigants during these cases. Okay, so if you want to read that article. It just very interesting. There was everybody was getting involved. See how they I'm sure you heard of Nancy Pelosi, right? And people started trying to copy her trades. Now, we're also at an area where CEOs and insiders are selling at a record $69 billion of their stock, and the year isn't obviously over yet, but we're starting to see Elon, Jeff Bezos, Mark Zuckerberg, the Walton family starting to just get rid of some of these stocks. Why? Well, because they're really high, right? A lot of these stocks made absolutely incredible runs. Why not cash in on some of this stuff? And it's just very interesting times that we're in right now. We need to pay attention to what's actually happening. Prices for the CPI obviously rose significantly, right? Prices climbed to 6.8% in November compared with last year. It's the largest rise in nearly 4 decades, as we obviously feel the pinch of higher prices all around us, whether we're going to the gas station or the grocery store. Now, it didn't come too far over expectations, which could indicate that potentially this year over year, these spikes may be subsiding, slightly moving forward. But we'll see what takes place here as obviously new reports continue to come out. All right, then consumer sentiment, right? Everyone's saying the economy is so great, but consumer sentiment is still just crushed down to the pandemic low. All right, and then 11 million open jobs as the quitting spree continues. So what are we seeing in the labor market? Well, what's really interesting is there's a lot of available jobs and the unemployment rate is very low right now, but there seems to be some weird disconnect taking place. I mean, I've been going to a few places that are extremely understaffed. Like I'll go to a restaurant and the first thing on their menu is we're hiring, right? It's hard to get various labor. And think about it as a regular person. Do people really want to work for minimum wage, whatever it is in your area? In California, it's like $15 or something like that. Okay, if people work for minimum wage, $15, but yet gas here in California where I live is around $5 a gallon, right? And if you have to pay premium, it's even more. All right, so it's like they have to work an entire shift, and that doesn't even fill up a tank of gas. Like, what's the point? Might as well just not drive to work, and you can save money that way. It's becoming a very difficult environment to navigate, and as obviously unemployment rate has been dropping, the Fed, right? That's one of their goals to meet, right? A low unemployment rate. Though they're going to have to start obviously raising rates, and this is where this comes in. The Fed chairman Jerome Powell retires that word transitory. All right, he retired it. Right, he's been saying, it's transitory. It's going to subside. Supply chain disruptions, it's going to all work out, and it might over time, but clearly now inflation has spiked, and although that maybe because it's not too far from expectations, we're not going to get any big surprises, but it doesn't mean that it's not going to remain relatively high for a longer period of time. And when he said this, when he retired the word transitory, something very interesting happened in the bond market. You can see the 10-2 right here, right? It completely just collapsed that yield curve. It just fell flat on its face. And that is a big move to the downside in a yield curve. It's still far away from inversion, but after he retired that word, transitory, you can see how the bond market responded. And, that's not the greatest. We haven't seen a move quite sharp like that for quite some time to the downside. Now, coming up, we have the FOMC meeting. The Powell, he said that the Fed, they're going to discuss the speeding up potentially of bond tapering at the December meeting, right? We are already discussing that the Federal Reserve is going to start tapering in a little bit. Doesn't mean that they're going to raise rates, but you got to think the Fed is expected to speed it up, and that's what the market's kind of pricing in here. Okay, if they're expected to speed up the end of this bond buying, that means that they're trying to potentially pull forward the interest rate hikes that are coming. Now, this is where it gets interesting, right? How are they going to successfully raise interest rates with debt levels so high that can become very jarring for the market? And you got to really wonder here, Is the Fed going to follow through? Are they going to taper off, which it seems like it's certain. They are going to do the taper. They may even speed it up to end it sooner. And then the market now is pricing in 3 rate hikes in 2022. And if they follow through with all of that, how is the market going to react? Well, we already saw how the market reacts when they're very loose monetary policy, when they're lowering rates, and when they're increasing liquidity into the system. They do very well. So if the Fed follows through, what do you think is going to happen in the markets? Well, the market has been incredibly difficult this year, 2021, to navigate if you are a stock picker. If you are not a stock picker and you just invest in your 401k or you have, an index fund, well, then you're not noticing what's really taking place here. Okay, in 2021, right? 2020, you can throw your dart at a dartboard, hit a bullseye. But this is the percent of stocks in the NASDAQ, and the NASDAQ tracks over 3,000 stocks. Look at how many stocks have been completely obliterated below the 200-day moving average. Let me put this into perspective. 29% of the stocks are above the 200-day moving average. What's that? Why is that important? That's like that Godfather moving average. You don't want to trade stocks or hold stocks that are under that. You want stocks to be above that, and you want the 200-day moving average to be inclining. Okay? So what does this also mean? It means over 70% of stocks are below the 200-day moving average. Over 70, okay? But yet the market, right, the NASDAQ composite is at all-time highs. It's not far off of it. And we've seen this story before multiple times, okay, where the market heads lower, or the percent of stocks head lower above the 200-day, and then the market catches down, and then the market catches down, and then the market catches down. But we have not seen that yet. But if you don't believe me and it's been harder to navigate, right, well, just look at this. NASDAQ 100, right? Where is it at below its high? Well, it's right around its all-time high right now, okay? But then take a look at all of these darling names that we recently kind of just went over that just benefited all throughout 2020 with this huge move, obviously, what the Federal Reserve did as far as stimulus and then various government policies as well. PayPal is down around 40%. Twitter, Snapchat, Chewy, Lyft, Palantir, DraftKings, Pinterest, Roku, right? Bumble, Redfin, Baidu, Alibaba, Zoom, Robinhood, Teladoc, CRISPR, Penn, Beyond, Virgin, Lemonade, Peloton, right? Peloton, holy moly. Zillow, Stitch Fix, Clover, Chegg, and you know what? This is not all of them. I promise you that, because I'm thinking one right now. Nordstrom's, right? That's not on here. Ticker symbol JWN. That's down over 50% from its peak high. All right, so many stocks are getting completely and utterly obliterated, but you cannot see that if all you do is look at the Dow Jones, right? The NASDAQ 100 or the S&P 500. So what does this mean? Well, 2020, let me just point this out. It equaled easy money, right? If you were involved in the markets in 2020 and you were picking stocks, it was easy money. 2021, difficulty then increased, right? People got very familiar with options trading, right? They know how to trade calls, and they're still doing that. We can see that in various FANG stocks of retail activity. But 2021 became increasingly difficult to navigate. And being as that is, right, that euphoria is going to wane a little bit, which means you need to focus even more on risk. So what is 2022 going to bring? I think 2022 is going to be much more difficult because a lot of people are stuck in the mindset that stocks still go straight up and they're going to catch these large moves or expected, that they saw in 2020 and a very few in 2021 and early 2021. They're going to expect that also coming into 2022. So if they made big gains and they're starting to still push the limits while the market conditions are changing and what the Fed is doing is going to be changing, they're going to see that it's going to be a much, much more difficult market to navigate. This makes me think of the visualization of the hedonic treadmill or hedonic adaptation. It's basically, if you just look at a chart like this, when it goes up, you're happy. When it goes through time, this is what happens. You kind of midline and you get this euphoria and euphoric feeling, but yet the market conditions are changing, but your behavior doesn't. And then all of a sudden you go through this misery point in time. And that is going to happen if you keep that same strategy, obviously, throughout these different changing market environments. Let's take a quick look here at the 11 sectors now in the S&P 500. Okay, this is important. I actually stack rank these to descending from an RSI perspective. So that means it's going from stronger down to descending based off relative strength, the RSI indicator. And you can see up here, the top 4 are all, well, not all, they're all basically defensive names. You have consumer staples breaking out to all-time highs, technology closing all-time highs, utilities breaking out here as well, and then healthcare as well on top of all of that. Now, what's interesting about technology is, yes, technology has very few names that are largely weighted, okay? And those few names are Microsoft, Apple, and Nvidia, okay? This is where it gets very important. And a lot of people I know, they're calling for a crash, blah, 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 blah. That's not what I'm doing here. What I want to do is prepare you for what to kind of expect coming into the new year. Okay, so Microsoft, Apple, Nvidia, those are the top 3 holdings in XLK. Well, how did they perform this year? Microsoft is up about almost, it's called 55% for the year. 2021, it's up 55%. And last week, it had a huge week. It was up 6%. So this is a monster, not only for the technology sector, but also a huge weighting in the S&P 500. So one has to think, okay, what happens if we don't get this 55% growth next year, right? It's not going to always go up 55% every year, okay? Then you take a look at Apple. Now, this is crazy. Apple's up 35%. Huge. It was up 10.88%, getting very over crispy right here. We'll see how that manages, but you can see coming into 2022, is it going to have another 34% year? Maybe. We don't know yet. But what's insane is literally just a month or two ago, it was up around 8%. It didn't take long for this big spike up to the upside. And then Nvidia is also, a huge monster. This is 129% up here to date. 129%. So when you really take a look at this, all right, technology sector, right, is pushing all-time highs, right? And then the top 3 holdings are Microsoft, Apple, and Nvidia, which are also some top holdings in the S&P 500 and NASDAQ 100. If they don't get these type of gains next year, or we start to see them back off or even unwind, what does that mean for the S&P 500? What does that mean for other indices? If we take a look at the SPY on a weekly chart, on a longer term chart, it's butting up right to this area of resistance, which could take us up even higher, right? We can have a melt-up phase where it just flies us up higher, sucks in more people. That's something that we need to be careful for. But, it could grind up here to even 500 is a possibility. But I'm pointing this out because when we have the PMO, okay, I like to use this to say, hey, are we trading with wind in our face, or do we have the wind at our back? When it starts crossing down to bearish, right, it starts curling over. This period in time, it went from 2011 to mid-2012, and we didn't go 2012, yes. We didn't go anywhere. There was just a lot of volatility, okay? And then right here, in about even a longer range, you can see it started to diverge and started to head lower here. But, price didn't really go anywhere for 2014, 2015, 16, even into 2016. So multiple year consolidation. And there was even some big drips right there too as well. And you see right here, crossover to bearish as it put a new high, negative divergence. We started selling off. We had the pandemic crash. And why am I pointing this out now? Well, the wind is at our face, but we continue to press higher and higher, right? So pay attention here. Down here, right? The March bottom, which we already talked about, the Fed stepped in. The Fed stepped in, we had government step in, we had everybody step in to make sure that the market was taken care of, even though that we weren't doing anything to really produce, right? We were just at home, not working for the most part. I know there's obviously people that were working, right? But the mass majority, this is a big kind of shift that took place. So the Fed steps in. Now the Fed is stepping back in saying, hey, it's time to pull that punch bowl away. This is what our plans are to taper. They are giving us the heads up notice right now. And a lot of people are like, I don't believe it. I don't think it's going to happen. I don't think they can do it. But the thing is, if they do it, well, it would have an adverse effect, obviously, on the market, wouldn't it? It had a positive effect here. If they start to taper and start to pull liquidity out of the system, what is going to happen? What do you think is going to happen? Do you really think that Microsoft is going to go up 60% next year if that's the case? Do you think Apple's going to continue to just go parabolic like this? Do you really think Nvidia is going to have a 130% up year if that's the case? Well, let's look at the components of the S&P 500. All the mega cap stocks. Look at Apple, Microsoft, Amazon, Google. Google's another very important one. Tesla, Facebook, right? Nvidia. These are like S&P 500, right? These top 10 names make up for like 30% of the S&P 500, and they all benefited from a loose monetary policy from the Federal Reserve. So if they take that punch bowl away, which they're saying that they're going to do, but I don't think the market's going to wake up and realize it until like after a while they've already done it. They're pulling it away. It's certain they are going to pull back the taper. And if inflation continues to get out of control, they're going to be forced, right, to raise rates. It's not like they can lower rates here now in this environment unless they go negative, right? They're between a rock and a hard place, and you really need to wake up. If we look at the relative strength at all these companies, the relative strength between the FANG stocks, right, these big top mega cap stocks, over the S&P 500, you can see deterioration here taking place, right? Facebook's continuing to melt down. Apple is one of the strong ones. And guess what? Microsoft is one of the strong ones. And Nvidia is still above the 52. Even though Nvidia is starting to see a little bit of an unwind, it's getting a little sketchy, but it's still positive, right? But you got to understand, Apple, Microsoft, they're the leaders on relative strength. What do you see at XLK, right? We just talked about that sector, bringing it all-time highs. Is this going to sustain itself? All right? As we're seeing things like Amazon hasn't gone anywhere from a relative standpoint for multiple months. All right? That is not a good sign, and it had multiple opportunities to head higher and break out from its trading range. Okay? Netflix breaking down through the 50 EMA, and it's trading relatively lower and lower and lower. Actually, in late October, that was when it kind of peaked out there from a relative standpoint. So very interesting stuff taking place. And if we take a look at Google, right, Google is up 70% year to date. I said that one was important. 70% up year to date. This is going to be a very important one to watch. And it continues to press higher and propagate higher. And it still looks like it's in bullish context, right? But just understand, you can see the ranges here of volatility, kind of boom, 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 boom. It's expanding. This big move down, big move back up, big move down, and then all of a sudden it spikes right back up. All right, if we start to get unwinds and start below 2,800, below these 100-day moving averages, and we don't see a 70% gain in 2022, obviously that's going to suppress the market. So I'm not calling for a stock market crash, but if these start to back off or consolidate or go sideways like Amazon, right, the S&P 500 is not going to go anywhere. It's very hard for the NASDAQ, for the S&P 500 to perform when its biggest holdings are going sideways. If you take a look at copper has been putting in lower highs. It's also been putting in higher lows. And this is getting pretty tightly compressed. And this is a good economic indicator, right? People call it Dr. Copper. But if this starts breaking down, that's obviously also not a very good sign. And this is interesting to think about because inflation is running rampant, right? The bond market's not doing much as of right now, except the yield curve is continuing to flatten or head lower. Gold, you would think gold would be ripping during this time, but it's telling us something. It's a piece of information. It continues to propagate sideways. Just keeps going sideways. And that's interesting to me because during times of high inflation, right, you would think that gold would benefit during these times, but it's not doing so at this particular point in time, which could be telling that, hey, they do believe, right? They do believe that the Fed is going to fight inflation, and they're not willing to bet big right here to run up the price of gold, right? If gold starts falling flat on its face, what is the Fed doing, right, during that time? Well, they're fighting inflation. If you take a look at silver, silver's also just holding on to this area of support right here in a tight little wedge pattern, but it's below those key moving averages. And then you take a look at Bitcoin. Okay, Bitcoin definitely benefited from Federal Reserve policy. And now we're starting to see some weakness take place. It's still relatively high, but it hasn't gone anywhere for like 10, 12 months, right? If you just take a look at the right side of the screen, it's about 50,000. You just go all the way back to the left. I mean, that brings us to February, like basically Valentine's Day. If you take a look at oil, I mean, oil is becoming increasingly more volatile here too as well. Talk about a huge move, $85 down to 62, and then it's starting to bounce up. We don't know if this is going to be, a dead cat bounce or if it's going to start to consolidate within this area. But obviously, more volatility is coming into the markets. The dollar has been rising, and now it's forming somewhat of a bull flag right here. And we already know that when the dollar shoots up and it moves fast to the upside, the S&P 500 and various equities, they struggled during that time, especially various commodities. And now what's even interesting that most people aren't even recognizing is take a look at the TLT. Right? The TLT closed right here just above 148. And if you take a look going back to February, right? February is right around here. It's relatively flat, slightly up to flat, right? Whereas Bitcoin is relatively flat too. So the bond market the last 10 months has been performing the same as Bitcoin. That's crazy. That's some weird information, right? So we'll see here as it's been pressing up higher and then consolidating. We tried to break out, but then was a false little breakout. We'll see here if it wants to pick back up. And then we have the IWM small caps. They have not gone anywhere to help the market. And obviously financials, healthcare, information technology are big keys to growth in the IWM. And this here has just been in a trading range, hasn't gone anywhere really since February of 2021. All right, so this is what can happen to various indices. Obviously, we're seeing it live right here in IWM. So yeah, you want to see it back above 232 or 235. Or if you start seeing it crack below 210, that's going to be another piece of information, rather bearish. Let's look at a couple indicators and then we're going to kind of wrap this show up. Indicators, okay, this is the advanced decline volume line. Another divergence taking place here in the year of 2021. The price action on the New York Stock Exchange has been hitting higher and higher. Now we're starting to see a little bit more volatility as this put in lower highs as well. If you take a look at the NAMO, also the NIMO, these both have got very overextended to the downside, so it was likely to work off these overextensions to come back to more neutral, and that's exactly what it did. The market responded positively, but now take a note, as the market actually went higher this last week, actually the breadth suffocated itself a little bit down to the downside, creating another negative divergence in both the NAMO and the NIMO. So that's the New York Stock Exchange oscillator and the NASDAQ oscillator. Another thing to call out, as the S&P 500 closed at an all-time high, didn't quite hit an all-time high, but I think it was a closing all-time high. Take a look at the percent of stocks above the 50 and the 200-day moving average. Both there at a negative divergence, but on the move up, at least we're seeing some stocks participate, which is positive breadth right there. But keep in mind, we're hitting that all-time high, and we're doing so with significantly less stocks. You can see the VIX saw a big spike up, but the VIX, when it spikes up like this, doesn't really hold those levels for too long. And we talked about filling the gap. It filled this gap beneath us, and it closed right there for the day. So perhaps the market still has room to go. What I want to call out, though, now we have these three gaps above us and another one even higher at around 40, 45, and VIX gaps. They do usually close, and we're getting here this reading on a positive divergence. So that could potentially send us some volatility early into next week. And keep in mind, it's going to be pretty darn binary, obviously, because we have the Fed FOMC meeting. If we take a look at equal weight in the S&P 500, also putting on a little bit of a divergence here too. S&P 500 pressed higher, equal weight did not. Why? Well, simple. Big tech did really well. And an equal weight, if S&P 500 is cap weighted, so it's ran by the top 10 names, they're all heavy tech, well, this is going to perform better. And you can see equal weight, it did not do as good. Okay, if we look at the NASDAQ advanced decline line and we're looking at the EMA 20, 21, and 50, they are still pointing down and they're still below zero. You want to see these turning up and above zero. Okay, they're not there. All right, everybody. We went over a lot. All right, so just wrap it all up in a little conclusion. Okay, the Fed, the market, it's pricing in 3 rate hikes, as I already told you. They're pricing in, currently pricing in. That's what the assumption is. Rate hikes in 2022. Are they going to be able to come through with that? Is the Federal Reserve going to do that? We don't have that answer, unfortunately. However, it is pretty certain that they're beginning the taper process. So if they're going to stick to this like they did in 2018-ish area, right, just before that when they started raising rates, Are they going to be able to do that? And what is it going to be like with the amount of debt that we have in our system? The reason why it's so important to pay attention to this is because I want you to focus more on risk. If you focus more on risk, you're going to do significantly better than the YOLO crowd that did very well in 2020 and early 2021, but now are starting to feel like it's a lot more difficult environment to navigate. And I tell you one thing, if the Fed had your back then and it benefited you, yeah, that's why it was smart to not fight the Fed. But if you're going to not change your mind while the Fed does change their mind and market conditions change, well, guess what? Then you'd be fighting, obviously, the Fed, and it could prove to be a very difficult 2022. That's all I got for you, everybody. See you later.